Most self-employed buyers could qualify for a mortgage today if they understood how the numbers really work. Lenders aren't saying no because you're self-employed. They're saying no because you're showing the wrong version of your income. If you don't understand how your income is being calculated, you will keep getting denied and miss out on homes you could afford. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in helping self-employed buyers purchase the home of their dreams and stop receiving bone-crushing denials. So I was once referred to a client named Aaron, not Aaron Rodgers. Us Jet fans are still sour. Let's just call him Aaron. So Aaron had been a teacher, and then the COVID thing, of course, happened. And I think there's a lot of turmoil in the school system that he was working for whatever reason. His position got excess. He knew what he wanted to do. So he got into being a driver. So it turns out at the end of COVID and up until I met him, he was doing Uber, Lyft, and was doing a chauffeur service on the side. He actually had a couple cars, a couple nice ones for whatever reason. So he was making $10,000 a month for Uber, $10,000 a month for Lyft, and another, give or take, $10,000 a month in a private chauffeur type service. Now, he wanted to buy a house, live the dream, the American dream, of course, and he applied at a couple of big banks. They looked at his tax returns. Now you think, hey, 10,000 times 3 modes, right? It's 30,000 a month, $360,000 a year. It's a lot of money. Turns out he wrote off multiple cars, tons of expenses, and he showed a net of about 60,000 from a profit perspective. Now 60,000 for the year, about 5,000 a month. It's just not gonna cut it to qualify for the type of house he was looking for, which was around 800,000. So he was referred to us because he knew we specialized in the self-employed client and non-QM bank statement type loans. Turns out it was probably, guys, the easiest loan I ever worked on in my life. I asked him for 12 months of his business bank statements, clean deposits every single month, give or take, no real variance between what he was making on Uber, Lyft, and the private services. So we took his revenue that came in every single month, cut it in half, used that for the income, and it was super clean. It was actually one of the easiest loans I ever did in my career. And it just turns out he's being put in the wrong mortgage product by the big banks. And frankly, they just didn't offer this product. But I can hear you now, Andrew. What's the catch? There's no way it was so easy for you, buddy. With all the loans you've done, that it was the easiest. It was. The non-QM, the bank statement program for self-employed is such an easy loan. But hey, Andrew, I'm sure you gave him such a higher interest rate and he got raked over the coals with whatever the market rate is with the new program that you put him into. It's actually not true. The rate on the bank statement program for him, if I remember correct, was about a quarter higher, which is really nominal comparatively to just not being able to buy a home. And of course, I hear you, hey, Andrew, you're just giving us a guarantee of another crash. You're putting people into crappy loans that they're not going to pay, and us taxpayers are going to have to bail everybody out. It's just not true. The non-QM mortgages, bank statements, profit and loss, all these new loan products, which are amazing that we stand behind, have higher down payments, higher credit score requirements, and they require a lot of money left in the bank after you close. So I'm going to hop to my office now and I'm going to show you guys through my eyes, under the hood, as a mortgage professional, as if you were me, worked with thousands and thousands of clients, tons of these non-QM loan products. I'm going to show you exactly what it takes to qualify. And we're going to go through 3 scenarios. Using the example of Aaron, of course. We're going to go over his tax returns, why the big bank said no, so you guys can see why. Easy to show. Can't wait to show you guys. Second piece is, of course, a bank statement program, how he qualified so easy. And if the bank statement program, just as an FYI, didn't work because he had, instability or volatility with his monthly revenue, we had the P&L program. I'm going to show you how that works as well. So come to my office. Let's see what it takes to qualify. All right, guys, so here we are. We have Aaron self-employed. So the example that we're going to do, which I'm going to show you the 3 options, the tax return option, what that looks like from a rate perspective, the bank statement program, which he inevitably qualified for, and then, of course, the profit and loss program, which if for whatever reason he didn't qualify for that, he would have qualified for that one. Potentially, we'll go over all 3 of those options. So we were basing this off of a sale price of $800,000. Let's assume that it comes in for $800,000 from appraisal perspective. 20% down. That's typical for these type of programs. So here you go, 640 score. Now we're going to plug in for the payment, homeowners insurance of about $250 a month. Let's assume property taxes are about $1,000 a month. So outside of this, I remember he had a 740 credit score, which I can't show you the guy's credit, sorry guys, but what I can say is that he had 2 open car payments. So we're going to plug those in, just to show you guys up here a debt to income ratio, what it takes to qualify. So you see mortgage qualifications. So from a liability perspective, it wasn't a mortgage, it was a lease. I remember Aaron had 3 cars. 1, he owned free and clear. 2, he had bounces. Let's call it $60,000. Monthly payment of $800. Save. And we're going to do that one more time. Add another liability. Another lease. Save $50,000. Another payment of $800. Save. So there you go. The 2 cars, $1,600 a month from a debt perspective. Now, if we go back to the property, we have $800,000 sale price, 20% down. We have to figure out what the interest rate is. So if we go to Loan Sifter, which again is what us game saving brokers use, if we put in the sale price of $800,000, if we put 20% down, which is 80% financing, 740 credit score, let's assume Suffolk County. Heard it's nice this time of year in New York. If we look at what the par rate is, what we as a broker team would have been able to offer if it was now, looks like somewhere around 6.5%, guys, right over here. So if we plug in 6.5% as a 30-year fixed rate, which is what he was looking for, the all-in payment is right over here, guys, $52.95. Now, let's see the 1, 2, 3 strategy we deploy for self-employed clients. The big screen, of course, number 1, again, remember, 740 credit score from a qualification perspective, great credit. Number 2, had 2 open cars, which we see over here, $1,600 a month for payments, great credit profile, fine. Had 20% down and money left over, all good. So now the big thing is the income. So if we plug in the income, you have a Schedule C car service, self-employed. The title, of course, he's the owner. Phone number, for argument's sake, we'll just put in something generic. Start date, let's use May 1st of 2021. Now here's the thing, right? Business owner, self-employed, Schedule C. So let's look at some of the income. That's actually, I remember it was the business owner and it was open for 5 years. So I remember because it was over 5 years, if you do a conventional loan, it actually lets you do a 1-year average. But with that said, did it even work? Because again, just to show you guys what we see in the mortgage space, $5,200 a month plus $1,600 in cars, $6,900 of total debt. So here's our calculator. Now, this is a Schedule C, guys, straight from the IRS. So as you remember, $10,000 a month in Uber income plus $10,000 a month in Lyft income, killing it, plus $10,000 a month in private chauffeur type income equals $30,000 a month, times that by 12. This is per year. So $360,000 in total revenue goes right there. So that $360,000 in revenue, that's what we base it off of, right? No, we base it off of this number, which is the profit. Now, all within here are the expenses, right? What did Aaron do for advertising? Some car and truck expenses. Are there some commission and fees because of the services he offers? Labor. There were no depreciation on his vehicles with other benefits if he's offering, stuff for employees, insurance, interest. Did he do legal and professional service? I don't know. Maybe someone sued him, which would be kind of ironic. Office expenses, he probably had none. Some of these profit shares, none. Rent or lease. Some of these like travel, meals, deductible meals, things like that. Sometimes people use expenses. Now, all in, the total expenses, I don't know if he had an aggressive accountant. I would hope that they were viable, was, I remember, $300,000. So this left down here a $60,000 net profit. So as you guys can tell, $60,000 for the year divided by 12, it's $5,000. So if we come back over here, let's plug in $5,000 of income. So if we go here, we plug in $5,000. Now remember, we need this to say debt to income on conventional, 50% of the all-in debt or less goes towards income. Let's see what it is, guys. Plug it in, save. 105 and 137, I don't have to tell you, you don't do mortgage, but that doesn't get the job done. So on paper, 100% of his income is going towards his debt. So this is why, again, clearly, Aaron went to the big banks. These numbers didn't work. Doesn't matter which one you go to. You can go to all the big banks in your surrounding area in your county. They're all going to say the same thing, a big fat no. So what did we do? So if you see $360,000 a year in revenue, right? So 360, follow me. We got 12 months of the bank statements. So every single month, he had $30,000 coming in. So that $30,000 of monthly revenue, we give credit because he's a 100% owner. We give credit for right out of the gate, half of that. So half of 30,000 times 0.5 is 15,000. So if we plug in a new income number for a bank statement program, 15,000, where's our debt to income ratio go? Ooh, it's under 50. So he actually qualifies. But just remember, if we go back to this screen, if we change this to a non-QM mortgage, which we just did, what's the interest rate? We were starting at 6.5. Let's go back to Loan Sifter. Let's modify our search. Conventional loan type, let's go to expanded, which means non-QM. Click self-employed. And then the income verification, we're going to do right here, 12 months business bank statements to verify. Click submit. What do we got? What do we got? So that 6.5 goes to 6.75, which is no big deal. If you think about it, a quarter bump in rate when the person didn't qualify, I mean, self-employed clients would jump for joy at this, without a doubt. So if you increase it to 6.75, does it still qualify? It does. So 36% over 46. What does this mean? That of the 15 grand a month, right, of usable income with the new program, about a third of it is going towards the mortgage, which is 5401, and a little less than half is all debts, including the 2 cars. He qualifies without a doubt. So what if Aaron took off, I don't know, 4 months of the year? So 8 months of the year, he actually worked. So of the 8 months, he still pulled in $360,000. So instead of getting the bank statements, we would do a profit and loss program. So what if, again, in the case of Aaron, what if we reached out to the accountant and said, hey, we need a profit and loss of the last 12 months, and say the revenue number was still that $360,000. So over the last 12 months only, the expenses were $160,000. So that leaves $200,000 for the net profit. So again, we pull up an Excel. So something very basic over here. If we do revenue, right? If we do revenue, and over here, let's just say 360,000 for the year. And then over here, we go expenses. And there could be all different expenses, right? You have car expenses, we just saw, travel, meals, entertainment. It could be, gas for, you never know. It could be repairs. Could be X. Could be X, could be Y, could be Z, could be whatever. If all of these equated to, as we said, 160,000. So when you look at revenue on a P&L, it's just very basic. This is all that's required. Revenue, expenses, say down here is profit. So obviously, for all the Excel wizards in the house, 360 minus 160 is 200,000. So which is what we had on our calculator. So this is the exact document we're going to get from the client, call it Aaron. If he only is working, say, 8 months out of the year to get this number, the underwriting team's going to say, hey, that income's not consistent. 4 months out of the year, you're not getting it. We're going to disqualify you from the bank statement program, which is why we're talking about profit and loss. Profit and loss doesn't look at the month to month. It's like, hey, over the last 12 months, there was 360 in revenue, 160 in expense, 200 in profit, and this will be right from the CPA, which is super cool. We get nothing else. This is what we work off of. So again, 200,000 divided by 12. This is the income number we'd give Aaron credit for, 16,667, right? So this is actually even a little bit higher, which is always good. And the rate, most important, of course. You say, hey, Andrew, how much higher is the rate? It's going to be like 9, 10%, right, broski? No. We're going to change business bank statement 12 months. We're going to go up to now, see over here, guys, profit and loss P&L 1 year. Click that button. This makes you want to do mortgage, right, guys? Click that button. Here it comes. Rate goes up a little bit higher, goes up to 7.25. So let's see. Yep, it's about 7.25. So if we plug in 7.25, we want to make sure that it still works. We look at that debt to income ratio over here, guys, right? And it does. See, so 33%, 43%, that just means it's under 50% all in. So again, that's 16 and change a month. that 5615 payment's about a third of his monthly income we're giving him credit for in the P&L program. And is all in debt, including 2 cars, is still under that 50% threshold. So this is why the P&L program will work. Pro, of course, you wouldn't qualify for the tax return program we went over, for the bank statement program, but you don't give up there. The profit and loss program is still just marginally higher, and Aaron would have qualified for this, but he did in fact qualify for the bank statement program. Guys, do me a favor. I know this is amazing, but this is a lot to take in if you're just a consumer and you don't do mortgage for a living. So hop on the description, get in there, click on the link that says Self-Employed Mortgage Guide that I created for you guys, and just take a peek at it. It's a big overview of all the different loan programs for self-employed. Again, our 1, 2, 3 strategy, but it shows you the difference in the bank statement program, the P&L program, nice and easy so you can slow down and review it. It's in our description. Make sure you click the link. Now that you've seen what it takes to actually qualify to buy a home if you're self-employed, what if you're self-employed but you want to buy a home to invest in and move in? Or what if you're just a real estate investor in general and you want to see what mortgage options are out there to buy a larger investment portfolio? So make sure you check out my next video, guys. Real estate investors, are you picking the right mortgage type? It's going to be an amazing video talking about all the different options on the non-QM side. Make sure you watch it, guys. It's going to be lit.